Well, let's put the spotlight on financials. Goldman Sachs has a buy rating on Chola, AU Small Finance Bank, SBI Cards, while they have a sell rating on SBI and Aavas Financiers. To discuss this, the trends ahead, we have with us Mr. Rahul Jain, the co-head of Asia Financials and head of India Equity Research, Global Investment Research at Goldman Sachs, who joins in. Hi, Rahul. Good morning and good to see you win. Well, I like some of these contra calls, and the one that I picked out is SBI Cards. That's been a bit of an underperformer, but you have turned things around from a sell rating, you have a buy rating. Give us your rationale for that.
Good morning, Nigel, and good to be on your show. Just before get into the specific question that you've asked, let me just take a step back and paint the broader picture that we have for the whole sector. So we clearly remain cautious on the sector. Earlier in the year, we downgraded the sector, calling out that the Goldilocks period is over because of three main factors. One was, of course, the deposit rates were looking to move up higher. Second one was the concern on asset quality was surfacing. And third was the slowing loan growth. Clearly, the view on the sector hasn't really changed much. The earnings headwinds continue to remain thick and heavy for the sector. Now, clearly, I mean, within the broader space, you always have certain themes emerge. What we are noticing is that in the unsecured space, the growth has slowed down dramatically. And clearly, this is the starting point for any future asset quality improvement that you will likely to see. So rather than commenting on the specific company, I would say that the credit card space, which has gone through over the last couple of quarters, some headwinds on asset quality should start to recede in the next couple of quarters because this is a shorter duration product and always the first one to go under in a down cycle and the first one to recover in an up cycle.
Oh, got that. Rahul, hi, good morning. I was just thinking, we just had the management of Muthoot earlier, so Gold NBFC, and there's a Bajaj housing listing. So two segments, right? Housing finance and gold finance were probably the safest segments in that sense. I don't know if you agree. But if you have a view on the housing finance segment, we'll get to some of the other calls of yours as well. Broadly on the sector, I mean, do you think this is a good space that investors must have exposure to? I'm asking, of course, also in the context of the Bajaj housing listing.
Great. Thanks, Prashant. So, of course, when the asset quality concerns emerge, and I'm linking it back to what I just said a while back, the money always moves to the safer asset classes. And in that context, housing finance is one such asset class where the investors have shown preference in our meetings with them, in our discussions with them. So clearly, I think the drift of the discussion or the positivity seems to be heading towards the secured and the predictable subsegments of the financials, and housing clearly forms part of it. The growth has been healthy, and clearly with liquidity becoming more benign in the system and the expectation of a rate cut in the next couple of months, investors are preferring some of these segments where the asset quality concerns won't be as significant as what you're seeing in the unsecured space. So definitely housing is definitely getting more traction with our investors.
So, hi, great to have you on the show today. Thanks for joining in. So just to expand on that point, on housing finance itself, Rahul, I mean, there's so much excitement. Again, we're not getting into today's specific listing, but I guess it's also a case of the market looking for ideas and the sector rotation that we're talking about. While the concerns you laid out, asset quality, slowing growth, those are very real and very fundamental in nature. In the face of the kind of liquidity and the sector rotation that we're seeing, do you see higher multiples for the so-called safe zones like housing finance? Just trying to understand the kind of multiples that people are talking about given today's expectations of the bumper listing.
Yeah, thanks, Urvi. So look, I mean, I'll bring it down to fundamentals on the earnings growth. Wherever the visibility of earnings growth is higher, whether it's relative or absolute, the money ends up chasing those stories and the valuation multiples tend to expand. Yes, we do get into the relative debate as well, depending on which company is trading at what multiples. And it essentially boils down to how do you see the earnings momentum playing out for those companies. So as I said earlier, that housing does look a decent space, at least in the near term to medium term, given the growth potential, given the asset quality has been benign, rates on the margin is expected to cut off, and the liquidity has been benign. The investors are willing to pay up higher valuation multiples for owning some of those names.
Okay. Fair point. Right, now let's come to the original question that Nigel started off with. I think that's a call that really caught everybody's attention in the market and ours. SBI Card, a lot of concern and caution around the company and the stock because of the go slow approach on unsecured lending. But you've turned bullish. So let's get to the rationale here.
Look, I mean, the overarching view hasn't changed. I think the unsecured space has seen significant growth over the last couple of years with heavy participation from different forces of markets across different subsegments. But like I said, every product segment goes through its own cycle. Credit cards, which is a fundamental payments product, is always the first one to experience any downturn in asset quality. And likewise, is always the first one to see bottoming out of asset quality concerns. So without specifically commenting on SBI Card, our view is that, given that the growth has slowed down in unsecured thanks to the actions taken by the RBI, sooner or later, the asset quality concern should start to peak in the next couple of quarters. And the credit card space, should be the first one to come out of it. It's inherently a pretty decent product, strong customer traction, and healthy margin in the returns profile. So this product should see the emergence as and when the asset quality concerns fully play out, which in our view should be in the next couple of quarters.
Rahul, I'm looking at the call on SBI, which has been a big outperformer actually year to date as well as in the last 1 year or so, and you've downgraded that name. But how are you viewing some of these private sector banks, that have been rank underperformers in comparison to a lot of these PSUs, and valuations? Well, they're pretty much still, digestible. Your take.
Sure. I think, look, I mean, generally, broadly speaking, on the PSU banks, there were two ways of looking at the valuation re-rating. And clearly, as the PSU banks in general have performed reasonably well in terms of fundamentals, be it asset quality or be it the improvement in the return on assets over the last couple of years post-COVID. So the first stage is always the asset quality, which has been pretty decent for this pack. And second is the return on assets, where we see headwinds increase. The headwinds is going to increase, like I said, across all the 2 or 3 parameters. One is the deposit rates, which seems to remain elevated given the market share loss for PSUs have been for real. And the second is, the asset quality, where in certain segments we are seeing increased delinquencies. And as these delinquencies translate into credit cost, the best of the credit cost period would be behind us. And this would put a pressure on the return on assets. In that context, we felt that the risk reward would be turning unfavorable. On top of it, you've seen a loan growth slow down for the whole sector. And like I said, if deposits is going to be harder to get through, I think there's a lot of work to be done over there first, then pay up the multiples for the growth. And hence the call on the SOEs with regards to the risk reward turning unfavorable.
But Rahul, isn't a lot of that already in the price? That's the question. All your concerns are, taken on board. We fully understand them. But that's the reason why these stocks haven't moved while the rest of the market has galloped away in the last 1 year, right? So isn't a lot of this already in the price?
Fair point. But if you see the ROA trajectory, and that's what the market always pays for, markets pays for the incremental change in your profitability or in your growth dynamics. And like I laid out earlier, if the return on assets are going to be facing pressure downwards, and growth is not going to be something which you would pay a superior multiples for, then clearly the derating or the risk reward, would start turning unfavorable. It's a combination of both the factors.
Okay. Rahul, I don't know, I think you've addressed it in, somewhat, but on the microfinance side, how much distance have we covered in terms of this down cycle that we're seeing? Are we halfway through? Are we only in the initial phases? What's your sense?
So in our conversation, clearly microfinance has been coming up with investors given the increased delinquencies over the last 2 quarters, predominantly because of higher leverage across the customer segment, and so much so that there has been an overlap with retail lending as well. But given the fact that this space has seen growth pick up only in the last 1.5 years or so, it has not been very deep. And therefore, in our view, the cycle should be relatively shorter. So hopefully in fiscal 25 itself, we should see the pain in the MFI space peak out. And then from next year, we start off on a clean base. What we are hearing from the industry is also that there is some self-imposed discipline they are applying, and clearly the growth over there is also consolidating, which is always a healthy sign. You try and fix where you've gone wrong, and then you start growing again. And therefore, in our view, I think this year you should see the pain out there to bottom out.
Rahul, just a quick word without talking about this one in particular, if you will, on exactly what that point. What kind of price to book multiples? I mean, you know, we used to look at 5, 6, 7 times, 8 times for lots of players, right? A few years before, I think, up till COVID. Not anymore. Do you think these stocks from the NBFC space can still trade at those kind of multiples? Actually, we do have maybe a Home First or an Aptus, etc., which have been the most expensive. Now, of course, I think Bajaj Housing is perhaps the most expensive. What's your sense, Rahul?
Great. Prashant, you know, it boils down to the predictability of the returns. If you think that the returns is going to be sustainable at where the companies are operating, plus if the growth is going to be stronger, then so also, you know, bring in the relative theory into the picture. We have seen in the past these stocks do tend to overshoot the valuation range. I would also say, you know, drawing upon my experience, that it also depends on how comfortable you are in terms of the number of years of earnings growth the company can deliver. So if the visibility out there remains strong, the market would always tend to pay a superior multiple for those franchisees, irrespective of which segment they would be operating in.
You know, the one name which continues to re-rate is PNB Housing.
Absolutely.
If we can have that up. It's moved up from 800 levels all the way to about, it was sort of around the 1100 rupee mark, but it's moved up another 3.5% this morning.
Yeah.
It's about 1180. I don't think the others are moving in with such gusto. Canfin and, you know, LIC Housing Finance, they all moved up a little bit on Friday, but I don't think this morning there's anything. A lot of it has, of course, already happened. Home First was a big mover on Friday. That's a private housing finance company, very sort of fast growth rates, but, you know, on your screen now, 2% more on Home First this morning, 1228.
You know, on PNB Housing Finance, Prashant, around 6 or 7 years ago, the stock was a 1400 rupee stock.
Yeah.
And then, in fact, it corrected from there. So, yes, it's seen a bit of a re-rating, but it's still been a big underperformer if you compare it to the levels of 2017. And a couple of points on the valuation parameter. Bajaj Housing Finance has an ROE of around 2.5%. You have PNB Housing Finance, it's at around 2.4%. And on valuations, post this listing, Bajaj Housing Finance trades at around 4.5 to around 5.5 times price to book, depending on what you're considering out there. That's on 2026. PNB Housing, well, it's trading at around 1.4 times, you know, give and take everything. So I think that's the reason why the street particularly is drawing comparisons out there. And on PNB Housing Finance, it's a AAA rated, you know, similar to Bajaj Housing Finance. So it's seen a big run. It continues to see interest. I guess valuations in favor, AAA rated, and as has been a big underperformer. It had 2 large blocks that took place in the last 60 days where demand outweighed supply. So I guess put all that together, the street continues to like it.
Absolutely. Well, you know, it's been great talking to you, Rahul. Thank you very much for joining us and running us through all of that, a lot about financials, and we look forward to our next chat. Thank you very much for being here on CNBC TV 18. Rahul Jain, co-head of Asia Financials at Goldman Sachs. Well.